Hey, Eric here from 5minuteinvesting.com. And today we're going to talk about people entering the market after all the good news are public. Now, chances are you don't know that, after all the good news are public and you're entering. Now, but before that, before we dive into this question, I just want to let you know there's a bunch of free stuff below. So if this is your first time to this channel, remember to click subscribe and check out some of the free stuff. So, why do people enter after all the good news are public? Or at least some of it, or most of it. Because you get excited. Because when there's good news, people spread it around. Let's say Apple beats its earnings for the 5th time. That's very exciting, right? Because it seems like a winner. It seems like there's a lot of energy, there's a lot of movement, and someone is making money, so then you want to check it out to see if you can make some money from this stock as well. So there's a lot of positive expectation, there's a lot of excitement related when there's good news. But chances are you are already too late. And you don't want to enter when you're too late because stock market is like hot potatoes and you don't want to be the last person that holds onto the potato. And usually the cycle goes like this. First, there's bad news and everyone wants to avoid it. And then after the bad news is public and is all known, it's reflected in the stock price. So what happens next? Well, the company will stay silent for a while, do a good job if it is a growing company or it goes bankrupt. Then the stock price will start to pick up as the company is performing better before the results are announced. Now, why is that? Because management, because employees know that they're doing a better job. They get more data faster than you or I because we are the retail investors, we are the small fish. So we wouldn't get the results and data as fast. And by the time they release them to the public, everyone knows about it. The employees, management would have already bought the stock. And that means by the time you hear about good news, you were already the last person to know. Because in the stock market, you got to think, after I buy, is there anyone else left to buy? Is there anyone else that are willing to pay an even higher price than this? That means in the future, there must be some sort of good news that will beat the good news you heard today. So for example, let's say Apple beats their earnings for the 5th time. Okay, fantastic. And if you buy right now, it will be at a high price for sure because everyone knows about it, everyone is excited. So then what you're expecting is that Apple will beat its earnings again for the 6th time, 3 months from now at an even higher gap. Let's say the analysts expect $1 million is $2 million. So an even bigger gap and it's even outperforming. So when you think about that, do you think that's really going to happen? Is it likely or not likely? And that's how you interpret the good news. In fact, in my trading strategy, I focus on finding bad news first because bad news means investors are fleeing away in the market and this creates a lower price point. I can enter at a lower price point and then I'll wait for the good news, which will eventually happen for good companies, and then I exit at a high. And that's how I invest. If you have any questions, leave your comments below and I'm happy to answer them. And of course, we announce winners to our technical analysis course to anyone who leaves the comments and subscribes as well. So yeah, good luck.